Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our FSC show, our Frac Spread Count show, where we want to look at what's happening in the U.S. markets in terms of completion activity. Then we're going to look at rigs, and then a little bit deeper into what are some of the flows that are moving from the Middle East, from Russia, when we start looking at crude as well as refined products, just because there's a bigger shift happening right now, and I think Russia is going to be a very important piece to that, and we really want to look to see how things are pivoting at that point in time. So just jumping right into it, we had a decline in completion activity from 259 to 255, so a drop of 4. And it's interesting because we did get some increases in areas that we were expecting, which most was really the Williston, Western Gulf stayed strong. We actually had a little bit of activity going into the Haynesville, but the Permian slowed down. We had three crews drop out of the Permian, which is a bit counter-seasonal. Typically, that's when we start to see some of this ramp up, and we really kind of stagnated at this level. It's interesting as well because even though the spreads are fairly low, in relation to where we thought they were going to be, you still have production that has moved up. So we have seen an increase in the amount of what's called the dual frac, simul-frac that is being adopted that's helping to bridge some of these gaps. So we're still getting some sizable increases in underlying production without the same level of completion activity. The problem is it's going to be difficult to see some of this activity going and kind of things that are going to continue down that path without seeing completion crews really starting to get closer to that 275, 285 level. We do think that we're going to see some of these increases going into October. But to be fair, I've been wrong. I thought we were going to go from this 265 up to about 275. Instead, we've come the complete opposite way to 255. We still should see some activity pick up into October, but the year is getting away from us. October, we'll see some activity as it normally does first week or two of November. But then as you head into Thanksgiving and into Christmas, for anybody who's watching this that is in the OFS or E&P community or energy community in general, those 6 weeks are pretty slow. Most E&Ps have used up their cash that they were going to spend for the year. OFS guys will take some extended vacation, just because typically for anyone that works in the field, 18-hour days, 6 days a week, 7 days a week sometimes, could be 4 on 3 off. So typically that's a period where you see some of that reduction and people kind of recharge, and then you get back at it as we head into January. So this is going to be an interesting one to watch as we start to see some of that progress, because if we don't see some of these crews, getting added as we get into October, we're going to have a little bit more of a drop off in production level than what we were assuming, or what normally happens as you go into Q1 of next year. So then when we look at rigs had another drop. So when you look at oil drop by 5, gas drop by 2, and the key and the pivotal piece that we keep talking about, horizontal. Our view is that even as we got to 565, we were going to start to bounce back up, but instead we continue to fall. Horizontals down to 553. There was some interesting data that as the price deck for crude stays here, that you could start to see some of the privates starting to come back. And it's interesting because it's possible, but when you look at where rates are, when you look at where inflation is still, especially on the labor front, is still hitting the energy space. There's no impetus to come back too quickly. Based on what we've seen so far, there's a lot of reasons why we're going to see things kind of stay where they are. And when I say that, I mean in relation to pricing. So for those that have been following us or reading our insights, we've been saying Brent is going to be 96 to 88 in that range, but holding closer towards that 93, 94 level. There's very little that we see changing that trajectory in the near term, just because the closer we get towards that top end, we're getting more damage to global demand. As we talked about in the Econ show, you're seeing a lot of pressure points in terms of flows, in terms of trade, in terms of the consumer. And that's, again, going to weigh on things going forward. Now, it's interesting because the problem that Russia has is Russia is struggling to get catalysts, get maintenance crews. So their refining side is slowing. Now, what the problem they have is, well, they still need to put crude out there because they don't have the level of storage other countries do because they were so reliant on pipelines that are no longer flowing. So if they're not putting it into their refiners and exporting it as product, which is a big problem, they're going to have to push it out as oil. So that's going to be something that we want to think about as we go through the next few charts. So here, when we look at global, crude flows, you can see Saudi has picked back up a bit. You have Iraq coming to the highs, and Iraq is the big winner with what Saudi's doing right now because they do have that medium heavy blend. They can increase pricing but still keep it well below where Saudi is, and they become the favored barrel. So that's the big piece. But you can see Saudi, holding into kind of the levels that we were expecting. The bigger pivot is going to be, well, what are they doing on the refined product side? So Russia right now plans near zero diesel exports next month, but only shipments that are exempt from sanctions are the planned ones that were already sold, which is going to be kind of that interesting pivot because we have seen about 2.8 million tons of diesel and gas refined products going to the market ahead of that ban. Even as we've had this tightness in the market from the future side, when you look at the market, CPC lowered their prices. Observed flows from crude from Russia's 3 western ports rose in September to the highest since June. And that's interesting because the flows from Russia are slowly increasing. And now, why wouldn't you do that when you look at, Russian Urals are trading at $83. They're well through the cap. Not that the cap ever really mattered. But they need this to go out because they don't have the capacity to run it to create product. So, but yet at the same time, and just looking at CPC blend, it was priced off of at a dated $1.65 below dated, compares to $1.10. So you're still seeing some pressure on the physical side. Not to, again, it's $1.65. There's previously when we were really weak, it was at $3.50. So I'm by no means saying it's a weak physical market. It's just giving us confidence that the range is going to stay intact and we're not going to see this huge break to the upside and break that $100 or things that people have talked about. Now, this is the interesting piece when you look at Russian crude flows, because you're now butting back to the highs. And as they struggle with maintenance season, it's going to be difficult for them to convert that into a product. So they're going to have to bleed this crude into the market and likely go above what they promised OPEC, given some of the math, especially when you think about they are already over that June level. So now when we start looking at gasoline and distillate flows, it should be of no surprise. China continues to pump product into the market. So now the question has come down to, is China going to issue a 4th export quota? Some of the early commentary has been no, and it's going to be interesting because when you say the no side, China's looking at this strategically because, one, if we say no, the margin will go up because the crack spreads will go up. 2, what is going to happen with Russia? Because a lot of people, including myself, were expecting diesel exports to be a bit higher. Instead, they've weakened significantly. So there might be more crude available, which means that they want to be able to kind of suss out what's happening in the market and can they capture this. And they also want to know what's happening with LNG and are we going to have a cold start to winter. So there's no incentive for China to come out and say, oh, no, we're definitely going to do a 4th export quota. Hold back on that information and let things develop. And then as you go into November, clearly they're dumping product into the market. There's still some of this back and forth. The question is going to be, are they going to do another one? And I think so far the short answer is yes. It's just going to be a matter of how much and at what, and what is the timing. So then when we start looking at exports from the Middle East, you can see Saudi Arabia breaking out to records. You can see Kuwait breaking out to the second highest it's ever been. So again, they're taking advantage of this market. So yes, they are not exporting as much crude, but they're exporting way more product and capturing that margin, especially on the middle distillate front, which we don't see getting much better. Gasoline, on the other hand, for anybody that's been following our EIA shows, we've been saying gasoline is going to get smoked, and here it is. Now, when we look at Russia, you can see that there's been a pullback on the underlying flows of gasoline and distillate coming from Russia. Excuse me. But when you look at the downstream drop, it's because Russian refiners are slowing amid seasonal repairs. The problem is those seasonal repairs are going to take longer, and that's going to be a much bigger issue. So then when we start looking at the U.S., the demand for gasoline still remains very low, well below seasonal norms, and is consistent with what we've been saying in terms of those concerns. And one of the things that we've highlighted is that it's going to result in more product coming into storage, which we've seen here. Our whole concept that we've been talking about through the EIA shows is that gasoline was going to have one counter seasonal build and then just hold that line. And as we've been saying, the comps were going to get easier. And instead of drawing down during that period, the comps were going to get easier, and the gasoline situation in the U.S. was going to improve considerably, which is why we've been so concerned about gasoline cracks, which have now come to pass. Now, the same can't be said on distillate. Distillate has had some builds, but again, by no means to the level that we need. But one of the interesting things is on the Shandong level, you can see that refinery run rates are still very low. So they're dumping product into the market, but yet activity is moving at a very seasonally low level. And that's that balancing act that we keep talking about as the U.S. continues to move further and further into our seasonal maintenance, which again peaks in October. Now, when we start looking at product, total oil and product stocks rose. The surplus widened from 22.9 to 24.7. That will hold after this week's EIA numbers. Land and floating, the surplus narrowed, and a lot of that is driven by land because on the floating side, there's more crude that is showing up on the water. A lot of that is driven based on what we've seen from Russia, which is why we've seen, even though the futures market had that nice little spike, we still remain at the higher end. You're not seeing the same level of strength in the physical market. You're not seeing a huge drop. That means that would say that, oh, futures are over its skis. Brent shouldn't be 95, it should be 85. We're not seeing that, but it's just that it's going to be that anchor holding it down as product stockpiles continue to rally higher, with the surplus widening from 1.1 to 8.6 and is now above that seasonal norm, which is what we were saying is that we're going to see some of that run up. And a lot of that is driven based on that slowdown in underlying consumption. Now, when we look at some of the activity levels, you can see that Europe is tracking the seasonal levels. In the U.S., North America, something similar, but yet we're not getting, and we're starting to slow back down after getting kind of that seasonal bump. And the same can be said in Asia, as Asia Pacific as well. Now, China had a nice little run up. A lot of that is driven because the holiday in China it's I think an 8 or 9 day holiday started yesterday I think it was Thursday today. Or I should say yesterday for them and us because we're on Friday. So that is where we got that nice little bump. We'll have that drop back. But again, it's just going to move along some of the seasonal lines, but it's still a bit stronger on the gasoline front. But and so that's why it's going to be interesting to see what happens on the retail side. Now, when we look at some of the data from the U.S., you can see that wholesale inventories continued to be weak. Retail inventories had a huge build, expected to be at 0.5, came in at 1.1%. And the interesting piece here is going to be the revised. So retail inventories were revised higher. Personal spending was revised a little bit higher last month, but here we missed some of those estimates. Real personal spending, again, fairly flat versus where we were the previous month. The PCE deflators, right in line with expectations. A little bit lower on the core deflator side, but again, still moving in the wrong direction when you start looking at the inflation pass. And then when you start looking at service activity, fairly flat on the Kansas City side, following, as we talked about in the Econ show, that big slowdown in manufacturing. So still kind of holding the line where slowing, but not aggressively slowing to the point that we're in this steep recession. It's just, it still lends itself to that slow, or that, the soft landing, if you will. The problem that, that we keep highlighting is that soft landing is going to be last longer than what I think the market expects. So that's what we have for you today. We hope you have a great weekend. If you're in New York, hopefully you have your rowboat to get home because it is sloppy out there. And we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.